Hello, welcome back to Financial Management. Our topic this week will be on forecasting cash flows. So let's just jump right in. Last lesson, we focused a lot on the role of financial managers and market efficiency. We went through identifying and calculating the correct discount rate for your future cash flows. It involved three steps: finding the correct risk-free rate for the appropriate time interval, choosing the correct market risk premium, then calculating the beta for your cash flows. This week, we're going to focus on forecasting cash flows. Good chapters to read to cover this material are Chapter 2 and Chapter 11. Next week, we'll get into financial and real options. Let's revisit our present value equation. So in the numerator, we have free cash flow for time period 1, 2, and all the way through infinity. And in the denominator, we have the WACC, the weighted average cost of capital, that we spent quite a bit of time developing and showing how to use last week. What's different this week is we're going to focus on the numerator. We're going to apply accounting concepts to construct pro forma financial statements. And again, the recommended readings will be Chapter 2, which does a pretty good job of going over the basics of financial statements, and then Chapter 11, which shows different ways of estimating cash flows. So let's revisit our net present value equation. We can recall from our net present value equation that in the numerator, we have a cash flow at time 0 and expected cash flows for period 1, 2, and all the way through. Now, we're going to switch to focusing on the numerator, specifically to figuring out an accurate way of estimating future expected cash flows. Before, all of our future cash flows were typically given or assumed to us. Now our job is going to be to find a reasonable estimate of the future cash flows using pro forma financial statements. How? Well, with very reasonable assumptions. We're going to tie everything to a function of sales and then see how, given our expectation of sales for the firm, what do we expect in terms of our balance sheet and ultimately our funding needs. Constructing pro forma financial statements is going to require us to have an understanding of financial statements in general. It's going to be expected that you know already a little bit about this, but in case you don't, we're going to go through three of the main financial statements: an income statement, a balance sheet, and a statement of cash flows. The income statement. The income statement is going to record flows of revenues and expenses over time, usually 1 year or 1 quarter. So if you've ever heard somebody say a P&L statement, this is what they're talking about. The phrase bottom line is going to refer to the last line of the income statement, which is going to report the firm's net income. Another synonymous term for net income is earnings. To be clear, net income is not cash flow, because we'll see that under accruals accounting, there'll be a difference between when a transaction occurs and sometimes when the cash is delivered. So let's look at an income statement. This is an income statement for a company called Global Conglomerate Corporation. What do you notice? Hopefully, first thing you notice is that in 2018, they had $176.1 million worth of sales. And in 2019, that number increased to 186.7. You'll notice that the cost of sales have also increased. So the first thing that we see are the total sales and the cost of sales, or sometimes referred to as the cost of goods sold. You'll also notice the gross profit. The gross profit is our sales minus our cost of goods sold. And then we're going to reduce our profit by these additional expenses. Our SG&A, basically if we had to spend any money to advertise, to let people know about what we do. Our R&D is expense. And then we're also going to expense our depreciation and amortization. If you're wondering why we expense depreciation and amortization, it's really going to be because we're worried about our taxable liability. So you'll notice that the line after that is our earnings before interest and taxes. So we depreciate our assets, it reduces our tax liability. And then after we have our EBIT, we still have to reduce by our expense, our interest income. The way the interest income works is we borrow some money last year, and this year we pay interest on it. And then we have our pre-tax income. And then finally, when we take out our taxes, we have our bottom line, our net income. So you'll notice that in 2018, our company had a net income of 1.9 million, and in 2019, that increased to 2 million. So let's look at our balance sheet. Now, the balance sheet is a snapshot of the financial position of the firm at a particular point in time. It's going to provide details about the assets, liabilities, and equity of the firm. The numbers you see on the balance sheet are book values of assets, liabilities, and equity. Hopefully, through doing the problem set, you've become aware that there's a difference between the book value and the market value. The market value is going to be based on market prices, and the book value is going to be based on basically our balance sheets or our accounting values. Now recall our famous accounting identity: assets equals liability plus equity. This also holds on the balance sheet. And what you'll notice is that typically the balance sheet will be split between assets on the left-hand side and then liabilities and equity on the right-hand side. So this is a balance sheet for our company. What do you observe? In 2018, we had cash totaling $19.5 million. And in 2019, that rose to $21.2 million. You'll also notice accounts receivable and our inventories. Our accounts receivable are essentially IOUs for the stuff that we sold, and our inventory is product that we've produced, but we haven't sold yet. So we'll think of our inventory as closely related to our cost of goods sold, and our accounts receivable is closely related to our sales. You'll also notice on the balance sheet that we have long-term assets. Well, what are they? They're our land, our building, our equipment, and you'll see that we also have to reduce our long-term assets by our accumulated depreciation. Lastly, I'll point out that we do also have goodwill and intangible assets on our balance sheet. And when we sum everything together, we get our total long-term assets. So our total assets in 2018 were $133.9 million, and our total assets in 2019 are $154.7 million. Let's look at the other side. So this is the right-hand side of our balance sheet. You'll notice that we have our liabilities and our stockholders' equity. We've got our current liabilities, including our accounts payable. So this is our IOU to those that we've had services from. We'll think of this as closely related to our cost of goods sold. We also have notes payable and our short-term debt. Those are our total current liabilities. Now, for our liabilities that are going to be due a year out, we've got our long-term liabilities, including our long-term debt. So remember all that interest expense that we had? Yeah, we've been borrowing. We also have our deferred taxes. And when we add those together, we get our total long-term liabilities. Lastly, you'll observe our stockholders' equity. Now, hopefully it's very clear that our assets are always going to equal our liability plus our equity. So things look good, things look in balance. A statement of cash flows. This is going to provide a statement of cash inflow and outflow from various operations for the firm. Net income is not a cash flow because we saw that it also includes depreciation in its calculation. Depreciation isn't cash. Depreciation is based again on these book values of our assets. Net income also does not incorporate cash spent on items such as inventory or buildings. More generally, net income is going to differ from cash flows under accruals accounting, as certain revenues and expenses are recognized under accruals accounting before or after the cash is actually exchanged. So the money can accrue to us as an expense or a revenue before the cash actually changes hands. And for us in finance, our focus is going to be on estimating and identifying the free cash flow for the firm. So let's look at a statement of cash flows. The statement of cash flows is going to be divided into three sections. We've got our cash flows from operations. These are cash flows from everyday business as usual stuff. Cash flows from investing. So this is if we have a capital expenditure, if we build a new plant, or if we acquire a firm. Then also cash from our financing activities. So our dividend payments and our stock repurchases. Let's take a look at a statement of cash flows. So this is our company, and what we observe is that in 2018, if we look at our operating expenses, we had net income of $1.9 million, depreciation and amortization of $1.1 million, and then we've got the different cash effects for changes in account receivable, accounts payable, and inventory. Now, in order to get our cash from operating activities, we're going to take our net income, and then we add up everything. And we add back our depreciation, our cash effects for changes in accounts receivable, payable, and inventory, we get our cash from operations. If we sum our cash from operations and our cash from investing activities, and as the firm, our investing activities, remember, are going to be building a brand new plant or acquiring a firm, a big capital expenditure. And then lastly, when we add in our cash from financing activities, we can get the change in cash and cash equivalents. So in 2018, our change in cash and cash equivalents was $1.7 million. And in 2019, our change in cash and cash equivalents was $0.9 million. If you have a moment, go ahead and take a look at a financial statement for a company you're probably familiar with, which is AMC. Again, you looked at financial statements a little bit, hopefully with problem set 1, you kind of familiarized yourself with these concepts. What I want to show you is a pro forma financial statement for a company that you've probably heard of. So this is a pro forma for Tesla. And this is something that you would often do if you were an analyst or if you were involved in any form of corporate finance, especially if you're doing anything internally with projections. You would want to basically have a sense as a manager or as somebody who's working in treasury or as a CFO, what are going to be our expected funding needs given the fact that we expect sales to go this way or sales to go that way. So there's still a few more concepts before we can build our pro forma financial statements. The first is going to be retained earnings. So this is the portion of net income that's not paid out, i.e. that's not sent out of the firm in the form of a dividend or retained or a repurchase. So we're going to retain these earnings. This is the earnings that we're keeping on. Stockholders' equity is typically going to be comprised of paid in capital and retained earnings. So what's the dividend that you're paying out? And then what's the retained earnings that's on the balance sheet? To update our retained earnings, we're going to take retained earnings from the previous period, add in net income, and then subtract out whatever our dividend payment is. So you can see there's a very clear relationship between the dividend that you pay, the net income that you make, and the retained earnings that you keep on the balance sheet. So with our pro formas, the financial statements hopefully are somewhat understood, and we can now move on to creating a pro forma financial statement. The way we're going to do this is by forecasting an income statement and a balance sheet. We need to make some proper assumptions about future numbers, such as sales growth, which we can base on historical data and future plans. We want to make sure that our assumptions are justified, and sometimes it's good to do sensitivity analysis to kind of see how your projections veer given these different assumptions that you're making. So how do we do this? For your pro formas, you're going to have projected sales growth. The key for projected sales growth is it's going to be the most important assumption for any of the pro formas that we're going to make in this class. Most of our other projected numbers are going to be based on projected sales. So our cost of goods sold is typically assumed to be a percentage of sales, meaning that if my cost of goods sold this year was 60%, then I'm going to assume next year it'll probably be 60%. So let's apply this to pro formas. What am I showing you? I'm showing you how our first step is going to be assume a growth rate of sales. So if sales historically grew by 5% per year, we would assume that sales would grow by 5% per year in the future. Once we have our sales growth, we can then start to figure out, well, what are the other projections that we have for our income statement that are also going to be a function of sales? The first is our cost of goods sold. So if my cost of goods sold this year was 40%, I'm going to assume it's going to be the same next year. My SGA, my sales and general advertising expenses. If it took 30% of my sales to sell and to make people aware of what we do, I'm going to hold that fixed as well. And the same for R&D. So our cost of goods sold, our SG&A, and our R&D are different expenses. We're going to assume are a fixed portion of sales. And with that fixed portion, we're then going to multiply them by our projected sales for the next period to get our pro forma income statement. We also have depreciation. So depreciation has a bit of a lag. You have an asset this year, it depreciates over the course of this year going into next year. Why is that important? It's important because in order for us to get a projection for our depreciation, we're also going to have to use our balance sheet. So from the balance sheet, we can observe what our PPE, what our big property and plant and equipment was last year, and we can observe what our depreciation is this year. We're going to assume that it's going to be fixed, and the last thing that we're going to use is our interest expense. So remember, we borrow a bunch of money last year. This year, we have to pay interest on it. So now we're going to go through an example of actually solving a pro forma statement for an income statement. So our next video is going to cover actually completing a pro forma with the examples that are uploaded on YouTube and in your course notes.